Before we begin, it's important to understand that this video is for informational and educational purposes only and does not constitute financial, legal, or insurance advice. I am not a licensed financial advisor or insurance agent. The information provided is based on research and experience, but you should always consult with a qualified professional before making any decisions regarding your personal insurance needs. Your financial situation is unique, and the strategies discussed here may not be suitable for everyone. The average American driver overpays for their car insurance by $435 every single year. Now, that might not sound like a life-changing amount of money at first, but what if you have 2 cars in your household? Now you're pushing $900. Over 10 years, that's $9,000. That's a down payment on a new car. That's a luxury family vacation. That's a significant chunk of a college fund. It's real money that you are systematically giving away for literally nothing in return. And the most infuriating part? You're likely being overcharged because you're a good customer, because you pay on time, because you've been loyal to the same company for years. This isn't an accident. It's a business model. It's called the loyalty tax. And today we're going to dismantle it piece by piece. This isn't just another video with a few generic tips like, raise your deductible. This is a complete masterclass, a step-by-step blueprint designed for one purpose: to stop the silent bleed of money from your bank account and put it back in your pocket, where it belongs. We are going to arm you with the insider knowledge that insurance companies hope you never learn. We'll decode the cryptic language on your policy, expose the hidden factors that secretly inflate your rates, and give you a repeatable system to ensure you are always paying the absolute minimum for the absolute best coverage, year after year. By the end of this series, you won't just be a consumer. You'll be an expert on your own policy. You will have the confidence and the tools to make insurance companies compete for your business, not the other way around. Let's be honest, everything is getting more expensive. Groceries, gas, housing, it feels like we're being squeezed from every direction. But here's the thing. You can't negotiate with the gas pump. You can't haggle at the grocery store checkout. But your car insurance? That is one of the single largest, most flexible bills you have, and you have far more power over it than you think. The problem is, the industry is built on a foundation of complexity and inertia. They know you're busy. They know you'd rather watch paint dry than read through a 50-page policy document filled with legal jargon. They are counting on you to just accept that annual rate hike notice, sigh, and pay it. Let me tell you a story about a guy we'll call Mark. Mark is probably a lot like you. He's a safe driver, hasn't had an accident in over a decade. He got his policy with a big-name company when he bought his first reliable sedan right out of college. For 12 years, he never missed a payment. He saw the commercials with the funny mascots and felt a sense of comfort, of security. He thought, they've got my back. Every 6 months, he'd get a new bill. Sometimes it went up $20, sometimes $40. He never really questioned it. He figured that's just what happens. Inflation, right? Then 2 things happened. First, his buddy at work mentioned he just switched insurers and saved $70 a month. A month. Mark did the math, that was over $800 a year. It was a seed of doubt. The second thing was the renewal notice. It arrived in the mail, and this time the increase wasn't $40. It was $95. For 6 months. No accidents, no tickets, no changes to his car or his commute. Just a nearly $200 a year price jump for no reason. That was the breaking point. Mark felt betrayed. He thought his loyalty meant something. But when he called his trusted, household name insurance company, the agent on the phone gave him a rehearsed, clinical explanation about rising costs in his area and new risk assessment models. There was no thank you for your 12 years of loyalty. There was no let's see what we can do to lower that for you. It was just pay it or leave. So Mark decided to look. And what he found was staggering. He discovered that the insurance world is a bizarre, upside-down marketplace where new customers are treated like royalty with steep introductory discounts, while long-term customers are treated like a captive ATM. He found out his credit score, something he'd worked hard to improve, could drastically lower his rates. But his current company never bothered to reevaluate it after his initial sign-up. He learned about discounts for his profession, for his home security system, for taking a defensive driving course online, discounts his agent had never once mentioned. Within 2 hours of shopping around online, Mark had 3 quotes. The best one wasn't just cheaper. It was $480 cheaper per year. But here's the kicker. It was for better coverage. a lower deductible for his collision insurance and higher liability limits, meaning he was actually more protected than before. He made the switch that afternoon. It was a few clicks online and one phone call. And just like that, he was saving $40 a month. He wasn't just saving money, he felt empowered. He had cracked the code. Mark's story isn't unique. It happens millions of times a year across the country. The insurance industry operates inside a black box. They feed hundreds of data points about you into a complex algorithm, and it spits out a number. That number is your premium. What's in that black box? Everything. Your zip code, right down to the block you live on. Your credit score, which they call an insurance score. Your marital status. Whether you're a homeowner. The exact make and model of your car, and its specific theft rate. How many miles you drive a year. Your age. Your gender. It's an overwhelming amount of information, and it's designed to feel that way. It's designed to make you throw your hands up and say, I can't figure this out, I'll just stick with what I know. But that's a myth. You don't need to understand the entire algorithm. You just need to understand the levers you can pull. You need to know the questions to ask and the discounts to demand. You need to know how to present yourself as the lowest possible risk, and therefore the most attractive customer. That's what this guide is for. We are going to open up that black box. Over the next several parts, we're going to walk through this process together. First, we're going to build your foundation. We need to understand exactly what you're paying for right now. We'll dissect your current policy's declaration page, translating terms like bodily injury liability, uninsured motorist, and PIP into plain English so you know what's essential and what might be overkill for your situation. Then we'll go on the offensive. We will expose the 5 biggest myths that keep drivers like you locked into overpriced policies. We'll arm you with a comprehensive checklist of over 15 common discounts that you need to be asking about, many of which your insurer will never volunteer on their own. Finally, we'll map out the switching process itself step by step to ensure it's seamless, simple, and that you never have even a single second of a lapse in coverage. This is your wake-up call. It's time to stop being a passive bill payer and start being an active, informed consumer. Your loyalty should be to your own wallet, not to a multi-billion-dollar corporation with a catchy jingle. So, before you do anything else, I want you to do one thing. Right now, pause this video and find your current auto insurance policy. Pull it up in your email, log into your account, or go find that stack of mail where you put the paper copy. Get it in front of you, because your journey to saving hundreds, maybe even thousands of dollars, starts with that single piece of paper. And when we come back, we are going to tear it apart line by line and find out exactly where your money has been going. You are going to be shocked at what you find. Okay, grab that piece of paper. Your latest auto insurance bill, your policy summary, whatever you call it. The one you probably just glance at before you pay it. This is called a declarations page. And it's not a bill. It's a battle plan. It's the DNA of your financial protection, and right now we're putting it under a microscope. Most people think this is just a list of confusing terms and numbers designed to make your head spin. And they're not entirely wrong. It is confusing, but it's not random. Every single line item, every number is a choice. A choice you made, or more likely, a choice that was made for you years ago that you've been paying for ever since. Let's start at the top. The easy stuff. Your name, your address, the cars you're insuring, and the people who are insured to drive them. Stop. Right there. Look at that list of drivers. Is your ex-boyfriend from 3 years ago still on there? Is your kid who moved to another state and got their own policy still listed as a primary driver on your minivan? Every name on that list is a risk factor. Every person is a variable in a giant, complex algorithm that spits out your premium. An incorrect name, an outdated address where car theft is higher. These are the tiny leaks that can sink a ship. Fix them. It takes one phone call. Now for the main event. The coverages. This is where the real money is. This is the heart of the contract. First up, you'll see something called liability. It's usually broken into 2 parts. Bodily injury and property damage. This is the most important coverage you have, and it's the one most people get dangerously wrong. Here's why. Liability coverage isn't for you. It's for the other guy. It's the money your insurance company will pay out when you are at fault for an accident. See those numbers? They probably look like this. 50/100/25. Or 100/300/50. It looks like a secret code. It's not. Let's translate it. Let's say yours says 50/100/50. The first number, 50, means your policy will pay a maximum of $50,000 for any single person's medical bills that you injure in an accident. The second number, 100, is the total maximum your policy will pay for all medical bills in a single accident, no matter how many people are hurt. So if you hit a car with 3 people in it, your insurance will pay up to $100,000 total, but no more than $50,000 to any one of them. The third number, 50, is the maximum they will pay for all property damage. That means the other person's car, the mailbox you hit, the storefront you smashed into. $50,000 total. Now you might be thinking, $50,000? That sounds like a lot. Let me tell you a story. A friend of mine, a good driver, had a momentary lapse. He was adjusting his GPS, drifted into the other lane, and clipped a brand new Mercedes SUV. Not a huge crash. But the driver of the Mercedes was a surgeon. The surgeon claimed a neck injury that kept him out of the operating room for 6 weeks. 6 weeks of a surgeon's salary, plus the $80,000 Mercedes that was now twisted metal. My friend had state minimum liability, which in his state was a laughable 25/50/20. His insurance paid out the max. All of it. And then the surgeon's lawyer came for the rest. They came for his house. They came for his savings. They came for his future wages. All because of a 2-second glance at a screen. Your liability limit is the firewall between your life and financial ruin. And skimping on it is like building a firewall out of paper. Right below liability, you'll probably see uninsured or underinsured motorist coverage. This is the flip side of the coin. This is the coverage that protects you when the other guy is at fault but he's a ghost. He has no insurance or he has that same worthless state minimum policy. 1 in 8 drivers on the road in America is uninsured. That's a terrifying statistic. It means the person texting in the lane next to you might have zero ability to pay for your hospital bills if they crush your car. This coverage is your safety net. It steps in and acts like the at-fault driver's insurance. It pays for your medical bills, your lost wages. Many people reject this coverage to save $20 a year. It is, without a doubt, one of the most reckless financial gambles you can take. Next, you'll see medical payments, or if you live in certain states, personal injury protection, also known as PIP. They're similar. Think of them as immediate, no questions asked medical coverage. Medical payments, or MedPay, is usually a smaller amount, say $5,000 or $10,000. It pays for you and your passenger's immediate medical needs after an accident, regardless of who was at fault. The ambulance ride, the emergency room visit, your health insurance deductible. It's fast cash for injuries. PIP is like MedPay on steroids. It's mandatory in some states and offers much broader coverage, often including lost wages and rehabilitation services. This is the coverage that keeps your mortgage paid while you're recovering. Okay, let's move on to the part everyone understands a little better. The coverage for your actual car. This is where your deductible comes into play. You'll see 2 coverages, collision and comprehensive. And next to each you'll see a deductible amount. $500, $1,000, maybe $2,500. The deductible is your share of the repair cost. It's the amount of money you have to pay out of your own pocket before your insurance company pays a single dime. So if you have a $1,000 deductible and you cause $4,000 worth of damage to your car, you pay the first $1,000 and the insurance company pays the remaining $3,000. Collision is exactly what it sounds like. It covers damage to your car when you collide with something. Another car, a tree, a guardrail, a runaway shopping cart. It pays out whether it's your fault or not. Comprehensive is the weird one. It's best to think of this as acts of God or everything else coverage. If a tree falls on your car, that's comprehensive. If a deer decides to redecorate your front grille, comprehensive. Hail damage, flood, fire, and most importantly, theft, it's all covered under comprehensive. Now, here's the game with deductibles. A higher deductible means a lower premium. By choosing a $1,000 deductible instead of a $500 one, you're telling the insurance company, I'm willing to take on more risk myself, so you should charge me less. And they will. This is one of the quickest ways to lower your bill. But you have to be honest with yourself. Do you have $1,000 sitting in an emergency fund that you could part with tomorrow without breaking a sweat? If the answer is no, a lower deductible might be the smarter, safer bet, even if it costs a little more each month. Finally, scan to the bottom of the page. You're looking for 2 things: discounts and endorsements. The discount section is a treasure map. Are you getting the multi-policy discount for bundling home and auto? The good student discount for your teenager? The safe driver or accident-free discount? the discount for having anti-lock brakes or an anti-theft device. These are not given automatically. You have to ask for them. You have to prove you qualify. This section is a list of free money you might be leaving on the table. Endorsements, sometimes called riders, are the extra toppings. Roadside assistance, rental car reimbursement, custom equipment coverage for your expensive new sound system. These are great, but they all cost money. Are you paying for rental reimbursement when you have a second car you could drive? Are you paying for roadside assistance through your insurance when you already get it for free through your credit card or car manufacturer? This is where you trim the fat. So take a good long look at that page. You now understand what it means. You know what you're paying for. You know what a 100/300/100 liability limit actually protects. And you know the difference between your collision deductible and your comprehensive coverage. You are no longer flying blind. But this is only half the story. This is the what. We haven't even gotten to the why. Why are your numbers so high? Why does your neighbor with the exact same car and the exact same coverage pay half of what you do? It's because your insurance company is keeping a scorecard on you. A secret profile built from dozens of data points you've never even thought about that labels you as a risk. And that risk score is costing you a fortune. And in the next part, we're going to pull back the curtain and show you exactly what's in your secret file. This file is known by many names. Some call it your insurance score, others a risk profile. But inside the industry, its most important component has a very specific name: the CLUE report. That stands for Comprehensive Loss Underwriting Exchange. It sounds boring and bureaucratic, and that's intentional. They don't want you digging into this. The CLUE report is essentially a 7-year history of every single claim you've ever been associated with, for both your car and your home. It's compiled by a massive data broker you've probably never heard of, a company called LexisNexis, and nearly every insurance company in the United States feeds information into it and pulls information from it when you apply for a quote. Think of it like a credit report but for insurance. And just like a credit report, it can be filled with errors, inaccuracies, and information that paints a completely unfair picture of who you are as a driver. But what's actually in it? Well, it starts with the obvious stuff. Every accident you've been in is listed. But here's the first shocking twist. It doesn't always matter if the accident was your fault. You could be stopped at a red light, get rear-ended by a texter, and do everything right. But that claim, the one the other driver's insurance paid for, can still be listed on your CLUE report. And some insurers will see that claim and raise your rates, operating on the bizarre theory that even if you're not at fault, you're somehow accident-prone. Gets worse. Let's say a tree branch falls on your car during a storm. You call your insurance company just to ask if it would be covered and what your deductible is. You do the math and decide it's cheaper to pay for the repair out of pocket, so you never file a claim. You just made an inquiry. Guess what? That phone call, that simple inquiry, can be logged on your CLUE report. To a new insurer, it can look like you had a loss, making you appear riskier than you actually are. You are being penalized for simply asking a question. Of course, your official driving record is in there too, the speeding tickets, the rolling stops, the citations. But this isn't just about your driving. That's the part they want you to focus on. The real story, the part that determines the price you pay, goes so much deeper. Because your secret file isn't just about how you drive. It's about who you are. And the single biggest factor in this file, after your claim's history, is something that has absolutely nothing to do with what happens behind the wheel of a car. It's your credit score. Yes, your credit. For years, insurers have been using a secret, modified version of your credit score, often called an insurance score, to predict how likely you are to file a claim. Their internal data, compiled over millions of customers, shows a statistical correlation. People with lower credit scores tend to file more claims. Now, whether that's fair or not is a raging debate. What does your Visa bill have to do with your chances of getting into a fender bender? The insurance companies argue it's a powerful predictor of risk and responsibility. Consumer advocates argue it's a way to punish the poor, penalizing people for a job loss, a medical emergency, or a student loan debt that has tanked their credit. But here's what's not up for debate. It can cost you a fortune. Take two identical 40-year-old drivers. Same car, same driving record, same address. Driver A has excellent credit, an 800 score. Driver B has poor credit, a 550 score. The premium for driver B can be double, triple, or even more. In some states, having poor credit can increase your insurance rates more than a DUI conviction. Let that sink in. Your financial history could be a bigger red flag to an insurer than you driving drunk. but they're just getting started. The next data point in your file is your address. Your zip code. Insurers practice what's known as territory rating. They use decades of data to carve up the entire country into thousands of tiny territories. And if you happen to live in a territory where people file more claims, maybe due to higher traffic congestion, more car thefts, or even just more lawsuits, you will pay more. It doesn't matter if you're the safest driver in the entire neighborhood with a pristine record. You are being judged and priced based on the actions of your neighbors. You could move 3 blocks, cross into a new zip code, and watch your premium jump by $400 a year overnight, even though nothing about you or your driving has changed. Next, they look at your job. Are you a delivery driver, a journalist, or a real estate agent who's on the road all day? You're a higher risk. Are you a scientist, an airline pilot, or a teacher? Their data says you're a lower risk. They'll even look at your education level. A driver with a PhD will statistically be offered a lower rate than a driver with only a high school diploma, even if they have the exact same driving record. They have run the numbers and found a correlation, so they use it. Are you married? Congratulations, your rates will probably go down. Insurers view married people as more stable and responsible. Single, especially a young single male? You are the walking embodiment of risk in their eyes, and you will pay for it. Then there's your insurance history itself. Have you had continuous coverage for the last 5 years? If you had even a 1-week lapse between policies because you were switching cars or just forgot to pay a bill, that's a massive red flag. You're now a high-risk driver, and you'll be thrown into a much more expensive pricing tier. They see that lapse not as a simple mistake, but as a sign of unreliability. All of this information, your claims, your inquiries, your credit score, your zip code, your job, your marital status, your insurance history, gets fed into a complex, merciless algorithm. There is no human compassionately reviewing your file. There is only a computer running a calculation and spitting out a single number, your risk score. This score is the key to everything. It dictates whether you get their best preferred rate, a standard rate, or if you're relegated to the expensive high-risk category. In some cases, it determines if they'll even offer you a policy at all. This is the secret file you're up against. It's a digital ghost built from pieces of your life that follows you from one insurance company to the next, whispering in their ear about what kind of risk you are and how much they should charge you. For most people, hearing all this is infuriating, feels unfair. It feels like you're being judged by a system you can't see, based on rules you didn't know existed. And for a long time, that's exactly how it worked. But that is starting to change. Knowledge is power, and what you now know is that this file exists. It's real, and it's affecting your wallet every single day. But here's the most important thing I can tell you. This score is not permanent. This secret file is not a life sentence. You have the right to see it. You have the right to challenge it. And you have the power to change it. Knowing what's in the file is the first step. The next is learning how to fight back. In the next part, we'll give you the step-by-step playbook on how to get your hands on your own secret CLUE report for free, and what to do when you find an error that's costing you hundreds, maybe even thousands of dollars a year. Alright, the playbook. This is it. This is the part where you stop being a passenger in your own financial life and grab the steering wheel. For years, this hidden report has been dictating your reality, adding a secret tax to your insurance bill without your knowledge or consent. Now it's time to turn on the lights. First things first, let's be crystal clear about what we're going after. The CLUE report, which stands for Comprehensive Loss Underwriting Exchange, is essentially your 7-year driving report card, graded by the insurance industry. It's managed by a massive data broker called LexisNexis. Think of them as the credit bureau of the insurance world. Every time you have a conversation with your insurer about a potential claim, every time a payout is made, every fender bender, every hail damage claim, it all gets funneled to LexisNexis and stamped onto your permanent record. When you apply for new insurance, that new company doesn't just take your word for it that you're a good driver. They pull this report. And what they see on that report can be the difference between a rate of $50 a month and $250 a month. So how do you get it? The good news is you don't have to pay a dime. Thanks to a powerful federal law called the Fair Credit Reporting Act, or FCRA, you are legally entitled to one free copy of your CLUE report every 12 months. Not a trial, not a special offer. It is your right as a consumer. Do not let any website try to charge you for this. Here is your step-by-step guide. The easiest and fastest way is to go online. Open up your web browser and search for LexisNexis CLUE Report Request. You're looking for their official consumer disclosure portal. It will be a LexisNexis Risk Solutions website. Once you're there, you'll need to provide some personal information to verify that you are, in fact, you. This will include your full name, address, date of birth, and likely your social security number and driver's license number. Now, I know what some of you are thinking. Giving my social security number to some website? And you're right to be cautious. But in this case, it's necessary and secure. Remember, this report is linked to your most sensitive data. They need to be absolutely certain they're sending it to the right person and not some identity thief. This process is federally regulated under the FCRA to protect your privacy. Once you submit your request, you'll often get access to a digital copy of your report almost instantly or within a business day. If for some reason you can't or don't want to do it online, you can also request it by phone or by mail. The LexisNexis website will have the phone number and mailing address listed. Just be aware those methods will take longer. Okay, so you've done it. The report is now in front of you. It's not going to be a pretty color-coded document. It's going to look like a boring black and white data file, because that's exactly what it is. But inside this boring file is the gold. You need to become a detective and scrutinize every single line. First, check the basics. Is your name spelled correctly? Is your date of birth right? Your address? An error here could mean your file has been mixed with someone else's, and you could be paying for their bad driving record. Next, look at the policy information. You'll see a list of your past auto insurance policies. Does it look right? Are there any gaps in coverage listed that you know for a fact didn't exist? An insurer might see a listed lapse in coverage and immediately classify you as a higher risk, raising your rates. Now for the main event, the claims section. This is where the real damage is often done. For each claim listed, you will see a date of loss, the type of claim it was, like collision, comprehensive, or liability, the name of the insurance company that handled it, the amount they paid out, and the status of the claim, usually open or closed. You are looking for ghosts. You are looking for mistakes. Here are the most common costly errors we see every single day. First, claims that are not yours at all. This is the most obvious error. You see a claim for a collision in a state you've never driven in on a date when you were at work. This is often the result of a simple data entry error or worse, a case of mixed-up identity with another driver. Second, incorrect details about a legitimate claim. Maybe you had a minor fender bender where the payout was $1,000 to fix a bumper, but the report says it was a $10,000 collision claim. To an underwriter, that's the difference between a minor incident and a major accident, and your premium will reflect that. Look at the type of loss as well. Was a cracked windshield from a rock on the highway a comprehensive claim? Incorrectly listed as a collision? This matters. Third, and this is the one that shocks almost everyone, the $0 claim. Let's say you backed into your mailbox, dented your bumper, and called your insurance agent just to ask if it was worth filing a claim. You talked it over, realized your deductible was $1,000 and the repair was only $800, so you decided to just pay for it yourself. You never filed a claim. You never got a check. But that initial phone call, that simple inquiry, can be logged by the insurance company and reported to LexisNexis as a claim with a $0 payout. Why is this so bad? Because the new insurance company doesn't see $0. They see claim. They see that you had an incident, that you were a risk. Multiple $0 claims can make you look like a high-risk, accident-prone driver, even if you've never cost an insurance company a single cent. It's one of the most unfair practices in the industry, and it could be sitting on your report right now, silently poisoning your rates. So what do you do when you find one of these errors? You don't call the old insurance company. You don't just get angry. You take action. You file a formal dispute, and you file it directly with the source, LexisNexis. Under the FCRA, LexisNexis is legally obligated to investigate any information you claim is inaccurate. You can start the dispute process on the same website where you requested your report. It's a formal process where you will point out the specific item on the report you believe is an error and explain why. Be specific. Don't just say, "This report is wrong." Say, "The claim listed on June 1, 2022, for a collision in Austin, Texas is not mine. I have never lived in Texas and my vehicle was in my possession in Florida on that date." If you have any proof, like a receipt from a mechanic showing the actual lower cost of a repair, or a police report that tells a different story, include it. But even if you don't have documentation, file the dispute anyway. The burden of proof is not on you. The burden is on them. Once you file, the clock starts ticking. LexisNexis generally has 30 days to investigate your claim. They will contact the insurance company that originally supplied the information and ask them to verify it. If the insurance company cannot verify the information, or if they admit it was an error, LexisNexis is required by law to remove it from your report. Period. Once the investigation is complete, they will send you the results in writing, along with a free copy of your newly corrected report if a change was made. But here is the final, most important step. This is the power move that can save you money immediately. If an error is corrected and removed from your report, you have the right to ask LexisNexis to send a notification of the correction to any insurer who has pulled your report in the last 2 years. Think about that. You can have them officially inform your current, high-priced insurer that they based your rate on false information. This can trigger a mid-policy rate reduction and, in some cases, even a refund for the overpayments you've been making. This isn't a secret trick. This is your legal right. You have the right to see your data. You have the right to ensure it's accurate. And you have the right to correct the record when it's wrong. But what if the record is right? What if every claim on that report is accurate, but your rates still feel astronomically high? What if the system is working exactly as it was designed, but it's still working against you? That's when you need to change the game entirely. And that's exactly what we're going to break down in the next part. So let's change the game. The first, and maybe the most radical way to do this, is to completely change the rulebook on how you're priced. For decades, insurance has been a game of statistics and stereotypes. You live in this zip code, you're this age, you have this credit score, therefore you are this risk. It's impersonal. It's frustrating. And often it's just plain wrong. But what if you could force them to judge you not by who you are on paper, but by how you actually drive, minute by minute, mile by mile? This is the promise of telematics, or what the industry calls usage-based insurance. And it is, without a doubt, the biggest shift in auto insurance in the last 50 years. Think of it like this. A company like Progressive with its Snapshot device, or Allstate with DriveWise makes a bet. They say, we think our best customers are being overcharged because they're lumped in with the bad drivers in their demographic. So prove to us you're a safe driver, and we'll slash your rates. Now I know what you're thinking. A little device in my car? An app on my phone? Is my insurance company going to track my every move? Are they listening to my conversations? It's a valid concern. The Big Brother fear is real. But let's pull back the curtain on what's actually happening. These programs are not tracking where you go to dinner or who you visit on a Saturday night. They are tracking a very specific set of data points directly related to risk. They're measuring 3 main things: how you brake, how you accelerate, and when you drive. Are you constantly slamming on the brakes? That suggests you're following too closely. Are you flooring it from every stoplight? That's aggressive driving. Are you frequently on the road between midnight and 4 a.m.? Statistically the most dangerous hours to drive? All of these are quantifiable risk factors. Let me tell you about a guy named David. David was 24 years old, living in a major city, and driving a 10-year-old Honda Civic. On paper, he was an insurer's nightmare. Young male, urban zip code. His quotes were coming back at over $3,000 a year, which was more than the car was even worth. He was a great driver. No accidents, no tickets, but the system didn't care. He was a statistic. Frustrated, he enrolled in a telematics program. For the first 30 days, he drove exactly as he always did. He got his score back and it was good but not great. The app showed him exactly why. He had a few instances of hard braking during his morning commute in heavy traffic, and he occasionally drove home late from his friend's place on a Friday night. So he started to change the game. He began leaving a little more space in front of him in traffic, allowing him to brake more gently. He made a point to leave his friend's house an hour earlier on Fridays. He wasn't driving less, he was driving smarter. The app gave him real-time feedback. His score started climbing. After 90 days, his renewal offer came in. His premium had dropped by 32%. Over $1,000 back in his pocket, not because he got older or moved, but because he proved the stereotypes wrong. He took control. That is the power of telematics. It allows your actions to speak louder than their statistics. Now, the second way to change the game is more subtle but equally powerful. It's about understanding the psychology of the insurance company itself. You've heard it a million times. Bundle your home and auto to save. And yes, you'll get a discount, usually around 10 to 20%. But the discount is not the real prize. The real prize is what bundling does to your status as a customer. Think about it from their perspective. The insurance industry spends billions of dollars a year on advertising, trying to acquire new customers. It is incredibly expensive to get you in the door. If you only have your auto insurance with them, you are a flight risk. You're a free agent. Every 6 months, you can be lured away by a clever commercial or a slightly lower quote. But the moment you add a second policy, your renter's insurance, your homeowner's insurance, everything changes. You are now what they call a sticky customer. The effort for you to shop around and move not 1 but 2 or 3 policies is significantly higher. You're less likely to leave, and because of that, they will fight harder to keep you. You're no longer just a number on the auto insurance spreadsheet. You're a multi-line household, a more profitable, more stable asset. This transforms your relationship with the company. When a big rate increase comes down the pipeline for everyone in your state, who do you think they're more willing to work with? The person with a single $1,000 auto policy, or the person with a $3,000 household account? You gain leverage. You're in a position of power when you call their customer service or, more importantly, their retention department. You can say, "Look, I've been a loyal customer for years. I have my home and auto with you, and this new rate is just not competitive. I'm getting quotes to move my entire account elsewhere." That conversation is an alarm bell for them. It's a 5-alarm fire. Losing your entire account is a much bigger blow. And suddenly, they're more inclined to find a loyalty discount or an additional credit to keep you happy. Bundling isn't just a discount. It's a long-term strategy to make yourself too valuable to lose. Finally, the third way to change the game is to become a master of the fine print. You have to think like a detective, hunting for discounts they don't plaster on billboards. Most people just accept the discounts their agent gives them, but you need to actively pursue them. Start with your profession. Are you a teacher? A nurse? An engineer? A first responder? A scientist? Many insurers have a list of preferred professions that they consider to be lower risk, and they offer special rates, but often you have to ask for it. It's not automatic. Next, think about your affiliations. This is a gold mine. Are you a member of an alumni association? A credit union? A professional organization like the American Bar Association? Are you a member of a wholesale club like Costco or BJ's? ARP? USAA for military members and their families is the most famous example. But dozens of these affinity groups have negotiated special group discounts with major insurance carriers. These discounts can be substantial, but they are invisible unless you tell the company you qualify. You have to connect the dots for them, then go deep on your vehicle itself. Don't just say you have an anti-theft device. List them out. Do you have a passive disabling device? Do you have a GPS tracking system like LoJack? What about safety features? Don't just assume they know your 2022 model has them. Tell them, "My car has anti-lock brakes, automatic emergency braking, blind spot monitoring, and lane departure warning." Each one of those can be a small separate discount that adds up. And here's a simple one that people miss all the time: how you pay. If you're paying your premium monthly, you are almost certainly paying more. You're paying for the convenience. Most companies offer a significant paid-in-full discount if you can pay your entire 6-month or 12-month premium upfront. It's a guaranteed return on your money that's better than any savings account. By using your driving data, leveraging your value as a customer, and hunting for every last discount, you stop playing their game by their rules. You start making your own. You're transforming from a passive price taker into an active, informed negotiator. But even with the best policy at the best price, the true test comes when you actually need to use it. When the worst happens, when you have to file a claim, suddenly the entire dynamic shifts. The company that was so friendly when they took your money now has a new objective: to pay out as little as possible. And navigating that process is a completely different game, one with hidden traps and costly mistakes. So let's play that game. Let's walk through the moments after the crunch of metal and the shatter of glass. Because what you do here, in these critical hours and days, can mean the difference between a smooth recovery and a financial nightmare. This is the playbook the insurance companies hope you don't know. The first, most critical phase is what happens right there, on the side of the road, in the minutes after the impact. Your adrenaline is pumping. You might be shaken, angry, or confused. This is precisely when the most costly mistakes are made. Before you do anything else, after ensuring everyone is safe and 911 has been called, you need to switch your mindset. You are no longer just a driver. You are now a lead investigator, and your smartphone is the single most important tool you own. Your first job is to document everything. And I don't mean 1 or 2 blurry photos of the dent in your door. You need to photograph the scene like a crime scene investigator. Start wide. Get pictures of the entire intersection, the street signs, the traffic lights, the weather conditions. Are the roads wet? Is the sun creating a glare? These details matter. Then move closer. Photograph both vehicles from all four corners. Get close-ups of the damage on both cars, not just yours. Take a picture of the other driver's license plate. Then, politely ask to photograph their driver's license and their insurance card. Don't just write it down. A photo is indisputable proof. Find the vehicle identification number, or VIN, on their dashboard and take a picture of that too. Why? Because it confirms the exact make, model, and year, leaving no room for error later. Document any skid marks on the road, any debris. You are building a visual case file, and you can never have too much evidence. While you're doing this, the other driver might be very apologetic. They might say, "Oh, I'm so sorry, this was all my fault." Your natural human instinct is to be polite and maybe even say, "It's okay," or "Don't worry about it. Do not do this." And more importantly, never, ever admit any fault yourself. Don't say "I'm sorry." Don't say "I didn't see you." Even a simple apology can be twisted into an admission of guilt by an aggressive claims adjuster later on. Your response should always be neutral and fact-based. Stick to, "Are you okay?" And let's wait for the police. And that brings us to the next non-negotiable step. Always get a police report. Even for a seemingly minor fender bender, the other driver might try to talk you out of it. They'll say, "Hey, let's just exchange information, it'll be faster. We don't need to get the cops involved." This is a massive red flag. A police report is an objective, third-party account of the incident. It documents the drivers, the vehicles, the location, the conditions, and often includes a preliminary assessment of fault. Without it, the accident becomes a he said, she said situation, which is exactly what the other driver's insurance company wants. It gives them the ambiguity they need to deny or reduce your claim. Insist on a police report. It is your official record. The final and perhaps most subtle mistake people make at the scene is how they talk about their own physical condition. After a crash, an officer or the other driver will ask, "Are you hurt?" Your adrenaline is high, you might not feel any pain yet, so you say, "No, I'm fine." You have just handed the insurance company a powerful weapon to use against you. Injuries like whiplash or soft tissue damage often don't show up for hours or even days. But when you later file a claim for medical treatment, the adjuster will pull out that statement. "But you said you were fine at the scene." The correct and only answer to give is, "I'm not sure. I'll need to get checked out by a doctor." It's honest, it's accurate, and it protects your right to care. Okay, the scene is cleared. You're home. Now comes the moment of truth. You have to report the claim. Your phone rings, and it's an adjuster from the other driver's insurance company. They're incredibly friendly, sympathetic, and they just want to get your side of the story. In a recorded statement to speed things up. Hang up. Politely decline. You have absolutely no obligation to speak to the other party's insurer. Their job is to protect their driver and their company, which means their goal is to find a way to pin the blame on you. Anything you say to them can and will be used against you. Your first and only call should be to your own insurance company. You have a contract with them. You've paid them for protection. Report the basic facts of the accident. But know this. Even your own insurance company will want a recorded statement. And this is another minefield. Before you agree, take a breath. Write down the key facts. Date, time, location, direction of travel, what you saw, what you did. When you give the statement, be a robot. Stick to those facts. Do not guess, do not speculate, do not offer opinions. If they ask, "How fast were you going?" Don't say, "Oh, probably around 35. Say, "I was traveling at the posted speed limit." If they ask, "Where did the other car come from?" Don't say, "He came screaming out of nowhere." Say, "I first observed the other vehicle in the intersection." If they ask you to describe your injuries, don't say, "My neck is killing me." Say, "I am experiencing pain in my neck and back, and I have an appointment to see a doctor." Every word matters. They are listening for inconsistencies, for emotional statements, for anything they can use to assign you partial fault and reduce their payout. Remember, in many states, if you are found to be even 1% at fault, your claim's value can be reduced. If you're found to be 50% or more at fault, you could get nothing. This one phone call can determine the outcome. Once the statements are taken, an adjuster will assess the damage. They might send you to one of their preferred body shops. You are not required to go there. These shops often have agreements with the insurer to use cheaper, aftermarket parts or to perform quicker, less thorough repairs to keep costs down. You have the right to get an estimate from any licensed repair shop you choose. Get at least 2 independent estimates from shops with great reputations. This is your leverage. Then comes the offer. For both property damage and any potential injury settlement, the first offer is almost always a lowball offer. It's a test. They're seeing if you're desperate or uninformed enough to take the first number they throw at you. They're hoping you'll see the dollar signs, feel the relief of it being over, and sign away your rights. Don't fall for it. This is the start of a negotiation, not the end. And here's a pro tip that can be worth thousands of dollars, something most drivers never even think to ask for. A diminished value claim. Think about it. Your car has now been in an accident. Even if it's repaired perfectly, its resale value has plummeted. If you were to trade it in, the dealer would pull a vehicle history report, see the accident, and offer you significantly less money. That loss in value is a real, tangible financial loss caused by the accident. And in most states, if you were not at fault, you are entitled to be compensated for that loss. It's called a diminished value claim. The other driver's insurer will almost never offer it to you voluntarily. You have to demand it. You have to prove it, often by getting an appraisal from a third-party expert. But it is money you are rightfully owed. So why are we going through this entire grueling process? Because this entire gauntlet of recorded statements, body shop estimates, and lowball offers is the true test of an insurance company. The commercials with the funny mascots and the friendly agents don't matter when your car is wrecked and your back is in spasm. The only thing that matters is how that company behaves when it's their turn to pay. Before you switch companies to save a few bucks, you have to investigate their reputation for handling claims. You're not just buying a policy, you're buying a partner for one of the worst days of your life. And choosing the wrong partner can cost you far more than you'll ever save on your premium. So, how do you separate the good partners from the bad ones? How do you peek behind the curtain of slick commercials and catchy jingles to see how a company really operates when things go wrong? It's not about guessing, it's about a strategic investigation. And your first stop should be the hard data, the places where disgruntled customers go to make their voices heard officially. I'm talking about resources like the National Association of Insurance Commissioners, or the NAIC. This is probably the single most powerful tool the average person has, and almost nobody knows it even exists. The NAIC is an organization of insurance regulators from all 50 states. They don't have an agenda to sell you insurance. Their job is to regulate the industry, and they track one crucial metric: complaints. They compile this data into something called a complaint index. Here's how it works, and it's brilliantly simple. An index score of 1.0 is the national median. It means a company gets the expected number of complaints for its size. If a company has a score below 1.0, say 0.5, that's fantastic. It means they receive only half the number of complaints you'd expect. But if a company has a score above 1.0, like a 2.0 or a 3.0, that's a massive flashing red light. A score of 2.0 means they get double the complaints of a typical insurer their size. A score of 3.0 means triple. This isn't just one angry person on Yelp. This is a statistically significant pattern of customer dissatisfaction, tracked by state regulators. Before you even think about getting a quote from a company, look up their NAIC complaint index. If it's well above 1.0, you should seriously ask yourself if that $20 a month savings is worth dealing with a company that generates 2 or 3 times the industry standard for unhappy customers. Next on your list are the big independent surveyors, J.D. Power and Consumer Reports. These organizations are household names for a reason. They spend millions of dollars conducting massive, nationwide surveys about customer satisfaction across dozens of industries, and auto insurance is one of their biggest categories. They rank companies on everything from the initial purchase experience to, most importantly, claim satisfaction. They ask real customers thousands of questions. How easy was it to file a claim? How clear was the communication from the adjuster? Were you satisfied with the settlement amount? How quickly was your claim resolved? These reports cut through the marketing noise. A company can tell you they have great claim service all day long, but if tens of thousands of their own customers tell J.D. Power that the service was slow, the communication was poor, and the settlement was unfair, who are you going to believe? Paying a few dollars for a Consumer Reports subscription or spending 30 minutes digging through the free J.D. Power auto insurance studies online is one of the highest return investments of time you can make. It's like getting a cheat sheet for your final exam. But data and national surveys only tell part of the story. The other part is on-the-ground reality, and this is where you have to become a digital detective. Dive into online reviews, Google, the Better Business Bureau, even Reddit. But you have to do it with a critical eye. Don't just look at the star rating. A single one-star review from someone who misunderstood their policy doesn't mean the company is bad. Likewise, a flood of generic 5-star reviews could be suspicious. What you're searching for are patterns. Read the 1- and 2-star reviews. Are they all saying the same thing? Is everyone complaining about their claims being delayed for months? Is there a recurring theme of adjusters who never call back? Do you see dozens of stories about people being lowballed on the value of their totaled car? If you see 10 different people from 10 different states all describing the exact same frustrating experience, you're not looking at isolated incidents. You're looking at a systemic problem. You're seeing the company's standard operating procedure in action. Conversely, read the positive reviews. Are people consistently praising a specific feature, like a super efficient claims app or a particularly helpful agent? That tells you what the company prioritizes and does well. Let me tell you about two people, Sarah and Mike. They both got into nearly identical accidents, rear-ended at a stoplight, significant but not catastrophic damage. Sarah had spent weeks shopping for the absolute cheapest insurance she could find. She found a company online, one she barely heard of, that saved her $30 a month. She was thrilled. After her accident, she filed a claim. And then silence. She'd leave voicemails for her adjuster that went unreturned for days. When she finally got someone on the phone, they'd be vague, promising a call back that never came. They questioned every single item on the body shop's estimate. They delayed authorizing the rental car. The entire process dragged on for 6 agonizing weeks. The stress was immense. She missed time from work just trying to chase down answers. The $30 a month she saved, a total of $360 a year, ended up costing her thousands in stress, lost time, and a settlement that barely covered her repairs. Now let's look at Mike. Mike paid a little more, about $25 a month more, for a company that had a stellar NAIC complaint index of 0.6 and was consistently in the top 3 of the J.D. Power Claim Satisfaction Study. He filed his claim from the scene of the accident using their mobile app. Within an hour, he had a call from his dedicated claims representative, who explained the entire process. A rental car was arranged and waiting for him that afternoon. The adjuster approved the body shop's estimate within 48 hours, and the check was sent directly to the shop. From the moment of the crash to the moment he picked up his repaired car, Mike felt supported and informed. He never felt like he was fighting his own insurance company. The extra money he paid each month wasn't just for a policy. It was for the peace of mind. It was for a system designed to help, not to hinder. This is the core of it all. The reputation of an insurer's claims department is not a nice-to-have feature. It is the entire product you are buying. Everything else, the quote, the website, the app, the commercials, is just the packaging. And one of the best, most overlooked ways to get an honest assessment of that product is to talk to someone who deals with the packaging and the product every single day. An independent insurance agent. Unlike a captive agent, who only works for one company, an independent agent works with multiple insurers. They're like a broker. Their loyalty is to you, the client, not to a single corporation. They have filed hundreds, maybe thousands of claims with a dozen different companies. They know, from first-hand repeated experience, which companies have adjusters that are reasonable and quick to respond. They know which companies will fight tooth and nail over a $50 part. They know who pays out claims quickly and who will drag their feet for months, hoping you'll just give up and accept a lower offer. Finding a good local independent agent and just having a 30-minute conversation can give you more real-world insight than 8 hours of online research. Ask them point blank. If I get into a serious accident, who do you want in my corner? Who is going to make my life easiest and pay the claim fairly? Their answer won't be based on a commercial. It will be based on years of professional experience from the front lines. They've seen the good, the bad, and the ugly, and that kind of knowledge is absolutely priceless when you're making a decision that could impact your financial well-being for years to come. Because when that moment comes and you're standing on the side of the road looking at a wrecked car, the only thing that matters is whether the company you've been paying every month is going to be your advocate or your adversary. So let's talk about that choice. You've done the hard work. You've compared the quotes, you've read the reviews, you've maybe even called a few agents and gotten a feel for their culture. You found a company that you believe will be your advocate. Now comes the most critical and most frequently botched part of the entire process, the actual switch. This is the moment where a simple administrative error can turn your smart financial decision into a catastrophic, life-altering mistake. And it all comes down to avoiding one single cardinal sin of switching insurance: the coverage gap. A lapse in coverage, even for a single day or a single hour, is a black mark on your insurance history that can follow you for years. To an insurer, a driver with a coverage lapse is no different than a driver with a DUI or a history of at-fault accidents. You are immediately recategorized from a responsible customer into a high-risk liability. Your rates will skyrocket not just with your new company, but with every company you try to get a quote from in the future. In some states, the Department of Motor Vehicles gets an automatic notification. You could face fines, a suspended registration, or even a suspended driver's license, all because of a paperwork gap of a few hours. But that's the bureaucratic nightmare. The real-world nightmare is so much worse. Imagine this scenario. Let's call her Jessica. Jessica is a meticulous planner. She gets her new quote, and she's saving $60 a month. She's thrilled. She marks her calendar. Her old policy with Company A expires at midnight on Friday the 15th. Her new policy with Company B is set to begin at 12:01 a.m. on Saturday the 16th. Perfect, right? No overlap, no wasted money. Seamless. On Friday afternoon, she calls Company A and confirms the cancellation. On Saturday morning, she's driving to her sister's house for brunch. A teenager, texting and driving, blows through a stop sign and plows into her driver's side door. It's a bad accident. Jessica is shaken up but thankfully okay. Her car, however, is totaled. She stands on the side of the road, takes a deep breath, and calls her new insurance company, Company B. The agent is sympathetic, but asks for her policy number. She gives it to them. There's a long pause on the other end of the line. Then the agent says the 5 words that every driver dreads. "I'm not showing you're covered." Jessica panics. "What do you mean? My policy started today." The agent explains that while the policy was set to begin today, the first payment, which she had scheduled online, hadn't been fully processed by the bank yet. It was still pending. Therefore, the policy was not yet in force. It wasn't active. She was, in that moment, completely and totally uninsured. The teenager who hit her? He was driving his parents' car and had the bare minimum liability coverage allowed by the state, $15,000. Jessica's totaled car was worth $30,000. Her medical bills from the hospital visit ended up being $10,000. The other driver's insurance paid their $15,000 limit, and that was it. The remaining $25,000? That was on Jessica. Her $60 a month savings just cost her $25 grand, and her pristine driving record was now stained with a coverage lapse, meaning her next insurance policy would cost a fortune. This is not a scare tactic. This happens every single day, and it's completely avoidable if you follow a precise, non-negotiable protocol. Let's call it the Safe Switch Protocol. Step 1. Apply for your new policy and get an insurance binder. A binder is not a quote. It's a temporary, legally binding agreement from the insurance company that proves you have coverage while the official policy documents are being drawn up. This is your proof. Get it in writing, usually via email, and do not proceed until you have it in your possession. It should clearly state the name of the insurer, you as the insured driver, your vehicle, the coverage levels, and most importantly, the exact date and time the policy becomes effective. Step 2. Coordinate your dates but build in a safety net. The best practice is to set the start date of your new policy to be the same day that you intend to cancel your old one. Do not try to save a few dollars by creating a gap. If your old policy ends on the 15th, your new one should start on the 15th. Think of it like a trapeze artist. You never let go of one bar until your hand is firmly wrapped around the next. The ideal scenario is to have a 24-hour overlap. Yes, you'll pay for 2 policies for one day. It might cost you $5 or $10, but that $10 buys you absolute ironclad peace of mind. Step 3. Pay your premium immediately. A policy is not active until the company has your money. Don't schedule a future payment. Pay it right then and there with a credit card or debit card so the funds are transferred instantly. Get a receipt or confirmation number. Your binder might be the promise, but your payment is what seals the deal. Step 4. After you have the binder and the payment receipt, call the new insurance company's main customer service line. Do not call the agent who sold you the policy. Call the 1-800 number. Navigate the menu to Policy Services and speak to a licensed representative. Give them your name and ask them to confirm that your policy is active and in force. Ask for your official policy number. Write it down. Now you have verbal confirmation from the source, on top of your written binder and your payment receipt. You are triple covered. Only now, after completing all 4 of those steps, are you ready for the final step: canceling your old policy. Call your old insurer and tell them you wish to cancel. They will ask for an effective date. Give them today's date or whatever date you've chosen. Be prepared for them to try to keep your business. Just be polite but firm. Crucially, ask them how your refund will be handled. If you paid in full, you'll be owed a prorated refund for the unused portion of your premium. Some companies might charge a small cancellation fee, so it's good to ask. At the end of the call, ask for a confirmation email or letter of cancellation. You want a paper trail for everything. There's one more layer to this that separates the amateurs from the pros: notifying the other stakeholders. Your insurance status doesn't just exist in a vacuum between you and the company. You have to inform your state's DMV and, if you have a loan or lease, your lien holder. When your old insurer cancels your policy, they are legally required in most states to send a notification to the DMV. The DMV's automated system sees that policy 123 on your Toyota Camry has been terminated. It then waits to receive a notification from your new insurer that policy 456 has been initiated on that same Toyota Camry. If you followed the Safe Switch protocol, those notifications will cross in the mail, and the system sees you've maintained continuous coverage. But if there's a gap or a delay in reporting from the new company, the DMV might only get the cancellation notice. To them, you are now an uninsured driver, and they will act accordingly, sending you threatening letters, fines, or suspension notices. Making sure there is no gap is your best defense against this bureaucratic headache. Even more important is your lien holder, the bank or credit union that financed your car. Your loan or lease agreement explicitly requires you to maintain a certain level of insurance coverage, specifically comprehensive and collision, to protect their asset. They are listed on your policy as a lien holder or loss payee. When you switch insurers, you must ensure your new company lists them correctly and sends them proof of coverage. Most insurers do this automatically, but the ultimate responsibility is yours. If your bank doesn't receive proof of new insurance, they will assume you violated your loan agreement. They will then take out a policy on your behalf called force-placed insurance, which is astronomically expensive, often 3 or 4 times what you would normally pay. And it only covers the bank's interest, not yours. And they will add that massive premium directly to your monthly car payment. It's a costly, frustrating mess that is easily avoided by simply making sure your new insurance card has your lender's name on it. So you've navigated the switch perfectly. No lapse, no angry letters from the DMV, no panic calls from your lender. You're saving money and you're fully covered. Feels great, but the game isn't over. The first 30 days with your new insurer are a critical honeymoon period, where you can lock in even more savings and solidify your relationship. And there's one specific document they send you in that first month that over 90% of people throw away, but it holds the key to everything. And that document is your auto insurance declarations page. I know. Sounds incredibly boring. It's that packet of paper that comes in the mail a week or 2 after you sign up. It's filled with codes, numbers, and fine print. And for most people, it goes straight from the mailbox into the recycling bin, or maybe into a file folder never to be seen again. We assume, well, I bought the policy, I'm covered, this is just the formal paperwork. That assumption could cost you tens, or even hundreds of thousands of dollars. Think of the declarations page, or the deck page as it's called in the industry, not as a receipt, but as the architectural blueprint for your financial safety net. It is the single most important insurance document you will receive all year, because it is the one-page summary that legally binds the insurance company to what they promised you on the phone or online. It's the proof. It's the contract simplified. And if there is a mistake on that page, then your coverage is a lie. So let's pull out a metaphorical magnifying glass and dissect this thing, because understanding it is the final boss battle in getting the right insurance at the right price. When you get that document, the very first thing you need to do is check the simple stuff. Your name and address, the policy number, and the effective dates. Make sure they're all correct. Then look at the listed vehicles. Is your car's year, make, and model correct? Crucially, is the vehicle identification number, the VIN, 100% accurate? A single digit off in the VIN can give an insurer grounds to deny a claim, arguing the vehicle involved in the accident wasn't the one listed on the policy. This is your first and easiest check. Next, you'll see the section that truly matters: coverages. This is the meat of the policy. It's often displayed in a chart, and it can look like a foreign language. But it's actually simple when you know the code. First up is liability. This is the coverage that pays for the damage you do to other people and their property. It is the only coverage that's legally required in nearly every state. You'll typically see it written as 3 numbers separated by slashes, like 25/50/25 or 100/300/100. What on earth do those numbers mean? It's not a fraction. It's a code for 3 different limits. Let's use 100/300/100 as an example. The first number, 100, stands for $100,000. That is the maximum amount your insurance will pay for bodily injury to any one single person you injure in an accident you cause. The second number, 300, stands for $300,000. That's the maximum total amount your insurance will pay for bodily injuries to all people combined in a single accident. So if you injure 3 people, the policy won't pay more than $300,000 in total for their medical bills, no matter how severe their injuries are. The third number, 100, stands for $100,000. That's the maximum amount your insurance will pay for property damage you cause. This is for the other person's car, or if you hit a fence, a mailbox, or even a building. Now here's the terrifying part. Most people just get the state minimum liability coverage to be legal. In some states, that's as low as 25/50/25 or even less. Let's think about that. You have $25,000 in property damage coverage. You cause a chain reaction on the freeway and damage 3 cars. The average price of a new car in the US is now over $48,000. You haven't even totaled one of them, and you're already past your limit. Or you have $50,000 in total bodily injury coverage, and you cause an accident that sends a family of 4 to the hospital. An ambulance ride and a single night in the ER can eclipse that limit instantly. Everything above those limits, that comes out of your pocket. Your savings, your investments. They can garnish your wages. They can put a lien on your house. Choosing state minimum liability is like bringing a squirt gun to a forest fire. Your deck page tells you exactly what level of protection you have. If those numbers look scary low, this 30-day window is the time to call and raise them. It is often shockingly inexpensive to go from state minimum to a much safer level of coverage. Next on the list, you'll see uninsured or underinsured motorist coverage, often abbreviated as UM/UIM. This is one of the most important and tragically overlooked coverages. This protects you when you are hit by someone who has no insurance or not enough insurance to cover your bills. The Insurance Research Council estimates that 1 in 8 drivers in the United States is uninsured. That's nearly 13% of everyone on the road with you. This coverage pays for your medical bills and your car repairs when the at-fault party can't. Skipping this to save a few dollars a month is a massive gamble. Check your deck page to make sure you have it. Then you have medical payments or MedPay and personal injury protection or PIP. These are related. They both pay for your medical expenses and those of your passengers after an accident, regardless of who is at fault. That's why they're called no-fault coverages. This is your primary immediate medical coverage. It kicks in before your health insurance does. Why is that a big deal? Because it can pay your health insurance deductible, your co-pays, and other expenses your health plan might not cover. If you have a high deductible health plan, having even just $5,000 in MedPay or PIP can be a financial lifesaver. Finally, we get to the coverages for your own car, collision and comprehensive. Collision is simple. It pays to repair or replace your car if you hit another object, another car, a pole, a wall. It's for when the damage is your fault. Comprehensive is for almost everything else. It covers damage from things other than a collision. Think of it as the act of God or bad luck coverage. A tree branch falls on your car during a storm. Hail turns your hood into a golf ball. You hit a deer on a country road. Your car is stolen or vandalized. That's all comprehensive. For both collision and comprehensive, your deck page will list a deductible. The deductible is the amount of money you have to pay out of pocket for a claim before the insurance company starts paying. If you have a $1,000 deductible and your car has $8,000 worth of damage, you pay the first $1,000, and the insurance company pays the remaining $7,000. A higher deductible means a lower monthly premium, but it also means more financial risk for you in an accident. A lower deductible means a higher premium, but less out-of-pocket pain. There's no magic number here. The right deductible is an amount you could comfortably write a check for tomorrow without panicking. Look at your deck page. Does that deductible number make you sweat? If so, call your agent. The last section of the deck page, and the one that can save you the most money, is the list of discounts and surcharges. This is your report card. Every single discount you're getting should be listed here, plain as day. Multi-policy discount, good driver discount, paid in full discount, good student discount, anti-theft device discount, paperless billing discount. It's all there. Your mission during this 30-day honeymoon period is to read this list line by line. Do you see a discount listed that you don't think you qualify for? Call them. It might be a mistake that they'll eventually catch, causing your rate to suddenly skyrocket 6 months from now. More importantly, do you not see a discount that you do qualify for? Did you install a new security system in your car? Did your kid get a B average or better last semester? Did you take a defensive driving course? This list is your proof. If a discount is missing, you are being overcharged. Period. One phone call to point out a missing discount, proven by your very own declarations page, can lower your premium for the entire life of the policy. This one document, this boring-looking piece of paper, is your tool. It's your leverage. It's your confirmation that the promises made to you are real and legally binding. Throwing it away is like throwing away the deed to your house. In that first month, you need to read it, understand it, and question everything on it. Because once you've had a claim, it's too late to discover that the blueprint for your financial safety net was drawn incorrectly. But by fixing it now, you're not just buying insurance, you're guaranteeing your peace of mind. And that peace of mind is what allows you to handle the single most stressful part of the entire insurance process: filing a claim. It's the moment of truth, the one moment where every decision you've made, every form you've signed, and every dollar you've paid comes into focus. This is the final exam, and the grade you get can alter the course of your financial life. All the research, the comparisons, the conversations with agents, it all culminates in a single phone call made from the side of a road or a hospital waiting room, your heart pounding in your chest. And in that moment, you will discover one of two things. You will discover you bought a promise, or you will discover you bought a piece of paper. Let's imagine the person who only shopped for the cheapest price. They saw a catchy ad, got a quote online in 5 minutes, and saved $73 a month. They felt brilliant. For 2 years, everything was fine. The automatic payments went through, they got a new insurance card in the mail every 6 months, and they never thought about it again. Then one rainy Tuesday, a car runs a red light and slams into their driver's side door. The car is totaled. They have a broken arm and severe whiplash. The other driver? They have no insurance. A ghost. Now the nightmare begins. Our driver calls the 1-800 number on their insurance card. They're put on hold for 45 minutes. When they finally get a human, it's a call center employee thousands of miles away who asks for a policy number they can't find because their papers are in the glove box of their mangled car. Over the next few weeks, they are passed from adjuster to adjuster. One handles the car, another handles the injury. They never speak to the same person twice. They leave voicemails that are never returned. They send emails that vanish into a corporate black hole. The company's first offer for their totaled car is an insult, a lowball number based on a flawed valuation report that they have to fight tooth and nail to correct. Then comes the medical side. They discover that the uninsured motorist coverage they thought was full coverage was actually the state minimum. The $25,000 it provides is gone in a flash after the ambulance ride and the emergency room visit. Their own health insurance has a high deductible they now have to pay out of pocket. The physical therapy they need to recover? That's on them. Suddenly, that $73 a month they saved feels like the most expensive mistake of their life. They are injured, stressed, out of a car, and now facing a mountain of medical debt. They didn't just buy a cheap policy. They bought a front-row ticket to their own financial destruction. The company they paid to protect them is now their adversary. Now let's rewind. Let's imagine you followed the steps. You didn't just look for the cheapest price, you looked for the best value. You found a reputable local agent who took an hour to walk you through your quote. You understood your liability limits. You didn't just accept the state minimums. You opted for robust uninsured and underinsured motorist coverage, $250,000 just in case. You added medical payments coverage. You even opted for rental reimbursement and OEM parts coverage for your new car. You paid a little more, yes, but you knew exactly what you were buying. You were buying a fortress. The same rainy Tuesday, the same red light runner, the same devastating accident. But your experience is completely different. From the side of the road, you don't call a 1-800 number. You call your agent's cell phone. They answer. They already know who you are. They calm you down, tell you exactly what to do, what to say, and what not to say. They ask if you're okay. They start the claim for you before you've even left the scene. By the next morning, a claims adjuster from your insurance company, a highly rated company you and your agent chose together, calls you. They introduce themselves and give you their direct contact information. They will be your single point of contact through the entire process. A rental car, matching the size of your vehicle, is arranged and waiting for you that afternoon. The adjuster agrees your car is a total loss. Their first offer is fair. It's based on actual comparable vehicles sold in your area. There's no fight, no back and forth. The money is in your bank account in days. And your injuries, your robust uninsured motorist coverage is more than enough to handle everything. The hospital bills, the specialist, the physical therapy, it's all covered. Your smaller MedPay coverage kicked in immediately to handle the initial copays and deductibles, so you paid nothing out of pocket. You're not worried about medical bills. You're not hounding a call center. Your only job is to rest, heal, and get better. You weren't just a policy number. You were a client. You didn't buy a piece of paper. You bought a promise. And when it mattered most, that promise was kept. That is the difference. That is the entire point of this process. It's not about saving a few bucks. It's about ensuring that on the worst day of your life, you have a team of professionals on your side, ready to make you whole again. And this relationship doesn't end after the claim. A good insurance strategy evolves with your life. When you get married and add your spouse to your policy, a great agent will use that as an opportunity to review your life insurance needs. When you buy a house and bundle your home insurance, they'll talk to you about an umbrella policy to protect your new assets. When your teenager gets their license, they won't just add them to the policy. They'll talk to you about telematics programs, good student discounts, and the critical importance of raising your liability limits now that your risk profile has changed. It becomes a partnership, a proactive, long-term strategy for managing risk and protecting your family's future. So as we close this out, let's boil it all down. If you're thinking about switching, here is your final pre-flight checklist. This is what every single US driver needs to confirm before making a move. First, know your numbers. Do not proceed until you can confidently explain your liability limits, your uninsured motorist coverage, and your collision and comprehensive deductibles. Understand that 100/300/100 is a responsible starting point, not an aspirational goal. Anything less is a gamble you cannot afford to lose. Second, vet the company and the agent. Don't just get a quote from a company. Investigate its claim satisfaction rating from sources like J.D. Power. And don't just accept the first agent you speak to. Are they an independent agent who represents multiple carriers? Or a captive agent who only represents one? Do they take the time to educate you? Or are they just trying to make a quick sale? Your agent is your advocate. Choose them as carefully as you choose your lawyer. Third, read the endorsements and exclusions. This is where the devil lives. Are you covered if you drive for a rideshare service? Is your custom sound system covered? Do you have OEM parts coverage? Or will they use cheaper aftermarket parts for repairs? The standard policy is just a template. The endorsements are what truly tailor it to your life. Fourth, don't be penny-wise and pound-foolish. The cheapest policy is almost never the best policy. An accident with minimum coverage can easily cost you hundreds of thousands of dollars out of pocket. Saving $50 a month is meaningless if it leads to a lifetime of debt. You are not buying a commodity. You are buying financial security. Price is a factor, but it should never be the only factor. And finally, view this as a foundational financial decision. Your auto insurance is not a utility bill like your water or electric. It is a cornerstone of your financial house, protecting everything you own and everything you will ever earn from being wiped out in a single moment of misfortune. Switching your auto insurance can be one of the smartest financial moves you ever make. It can save you money, yes, but more importantly, it can drastically improve your protection and give you profound peace of mind. But it has to be done with intention, with knowledge, and with a clear understanding of what's at stake. You now have that knowledge. You understand the jargon, you know the pitfalls to avoid, and you know what a high-quality policy looks like. You are no longer just a consumer, hoping for the best. You are an informed buyer, capable of making an expert-level decision to protect yourself and your family. So go forward, get your quotes, ask the tough questions, and build your fortress. Because when that rainy Tuesday comes, and for millions of us it will, you'll be ready. You won't be holding a piece of paper. You'll be holding a promise. And that is a value you can't put a price on.